It's good. I've given you biology tonight. I've given you science. I've given you handwriting. Now I'm going to give you math formulas. Okay. So the math formula tonight is, what is DPI? Distributed capital divided by paid-in capital. Okay. So think of once again, it's a 10-year fund. So once again, we're put it into the frame of Stallions just because that's what we're talking about tonight. But once again, it could be any type of fund. You pay, the investors all put in their money. And for this simplicity, we say everybody put in $1 and there's 100 of them. So there's $100 in the fund. Obviously, there will be more, but we'll just keep it simple for the math. The distributed capital is what's been returned to investors already from the activity. So if everybody put in $1, there was 100 of them, and we've gotten 50 cents on that dollar back, the DPI at that point would be 0.50. Now, and DPI in the private equity world or the venture capital world is always measured or always stated in a decimal point, 0.50. But once again, if you remember your elementary school mathematics, 0.50 equals 50%, right? So you have a DPI of 50%. Okay? So all DPI is, it's the amount of money from what you've put in as an investor to what's already been returned to you. Okay, and that's over the life of a fund. So some things to understand about Stallions and DPI. The J curve, once again, remember talking about the J curve, it's shallow, but it really affects the DPI in the first 18 to 30 months, right? Because it's shallow, because we're still investing. It's still taking that time. If you remember back to that chart, that's why I educated you on that chart, that there's not a lot of bright colors in the first half of that chart, right? The bright colors come later. There's still in years 1, 2, and 3, a chance of distributions. They still can be significant. We're going to look at some of that. But the best years on assets should be years 6 through 10. If we've done it well, we're successful. Years 6 through 10 are where we're really counting the money. Distributions in our world happen once or twice a year, either in Q1 or it should be like an and or there, June. That's just because the nature of the industry, that's when money kind of flows back in. Once again, those foals are born in the first half of a year. So you can't collect any money until those foals are born. So it takes the first half a year. And by June, we've collected a whole bunch, and we usually do distributions there. In my opinion, as an investor in anything that's Wasabi Ventures Stallions, the single most important metric for me is I think about DPI. I think about how much money have I returned to investors. That's the single most important number that I think about. Some of the other numbers are going to be important as we talk about, but in my opinion, that's the most important. That's not always the same in other types of funds. Sometimes the appreciation of the assets themselves are the most important because you get one big exit at the end. It just depends on the nature of the assets. But for Stallions, I'm as the guy who eventually always has to pull the trigger and say we're investing or not investing and how much we're investing. I think about the DPI for my investors. How have funds 1 through 3 performed via DPI? Now, this is, I should have talked about this earlier when we were talking about the J curve. We are currently once again, we do an annual fund. So every year we raise a new fund. 2025 will be Fund 6. But if you remember, it takes a year, we fundraise, and we deploy that capital sort of near the end of the year. And, so there's kind of a year 0 here. So our very first fund we raised in 2020. So we raised it in 2020. We started deploying it in 2020 into early 2021. And so that's year 0. So Fund 1, if you think 20 and 21 are year 0, 20, 21, 22 is year 1, so on, so on. So there's been 3 years. So why I'm not talking about funds 4 and 5, it's impossible. If you remember the chart, it's very impossible to see a lot of returns. the fund's just in the bottom of the J curve. The numbers aren't interesting until you get to really year three. And then you can start to look at metrics and see what they mean. So fund one has a DPI of 67.43% so far. What that, once again, if you remember back to this couple slides ago, the math, that means the investors in fund one have already gotten 2/3 of their money back by year three of the sort of returnable sort of years. It's not bad, candidly. Pretty good story. And we're going to talk about some individual assets in fund one. Once again, fund was our first fund. Fund two, in many ways, has a very good chance to outperform fund one. There's some really interesting assets in there, and you can see that by the returns already. 63%, even though it's only had really 2 years of chugging along. Fund three has only had 1 year of chugging along, and you see it's got 21.63%. The average per year, that's just how many years has it had a chance to return, and taking the average there. So 22%, 31%, 21%. So those are pretty good returns if you think about that. Once again, now that you understand what DPI is, we're pretty proud of those numbers.